Hello, everyone, and welcome to Section 6, where we will cover some of the fundamental issues of income taxes. Before I get started, I have a couple of comments. We will discuss several issues real investors face, focusing on tax law fundamentals and their impact on real estate investments. However, I would like to emphasize that our coverage will not be exhaustive. For example, if you're considering purchasing a property today, I cannot accurately predict the taxes associated with that investment. I would need to know your investment history, the properties you own, your deductions on those other properties, if you have passive income, and passive losses. Again, we'll give you the basic understanding of the tax law, but admittedly, it is incomplete. Let's begin. Income taxes constitute a lien superior to that of the equity investors, whose interest is merely a residual. The income taxes must always be paid before investors can benefit from the investment. Therefore, the relevant measure of investment outcomes is the value of the after-tax cash flow. In this section, we will explain the nature and significance of the key tax issues surrounding the acquisition, operation, and disposition of real property. Let's talk about tax basis, its nature, and significance. Calculating the basis is one of the first steps in calculating your taxes. A newly acquired property's initial tax basis is the starting point in determining income tax consequences of the operation of the property and ultimately the tax consequences of the disposal. The tax basis is adjusted during the holding period to reflect any changes, so any relevant disinvestment or capital investment in the properties will impact the basis. Briefly, here is the process of calculating the basis under three scenarios. When a property is acquired by gift, the initial tax basis is the same as that of the donors, unless the donor incurs gift tax liability. When that occurs, the new tax basis will include a portion of the gift tax due to the property's appreciation during the donor's holding period. Next, the initial tax basis of the property acquired by inheritance is the market value at the date of inheritance. Finally, when property is acquired by purchase, its cost forms the buyer's initial tax basis. So, the basis includes everything of value given in exchange for the property and all expenses incurred in obtaining and defending the title. There is an issue here that we need to discuss. Sometimes you're acquiring more than one property or more than one asset. When we get into a situation where we must allocate the cost between two assets, the initial tax basis must be allocated between them using the ratio of the relevant market values of each asset. For instance, you're trying to allocate between the value of the land and the building. There are three different methods. First, one way of doing this, the allocation, is to specify each price in the original purchase contract. That would be easy if everyone did that. If the purchase price is an arm's-length transaction, such a contractual determination or delineation forms the defensible cost allocation basis. Another way you can do it is to use the ratio of land value to the building value estimated by the tax assessor. The assessor allocates the cost between land and improvements on the tax bill. For tax purposes, you could use that allocation to estimate the basis for the building. The last way to handle that allocation is to have an independent appraiser estimate the relative value of the land and the buildings. That's probably the most expensive route, but it is done quite a bit. Once we've figured out this value allocation, the next step is to use that to calculate the depreciation allowance. Okay, let me explain depreciation value. Now, when a property is held for business or investment purposes, but not for personal use or primarily for resale, taxpayers are entitled to deduct from their otherwise taxable revenue an allowance for the recovery of capital investment in the improvements. Theoretically, I can deduct a portion of that as they wear out. That allowance is called depreciation. Depreciation allowances apply only to property held for business or investment purposes. It does not apply to your personal residence or house use or property used primarily for resale. And the land itself is considered indestructible, and as such, you're not allowed to depreciate the value of the land. It is never depreciable. Okay, always keep that in mind when you're doing the calculations. Claiming a tax deduction for cost recovery allowances reduces the basis of the property. As such, The lower the basis of the property, when the property is ultimately sold, the greater the taxable gain on the disposal of that property. And that is a good thing. By reducing the basis and increasing the gain on the sale of the property is taxed at a rate much less than the ordinary income rates. I'm going to talk more about this a little later. Improvements in residential real estate can be depreciated over no less than 27 and a half years. If you are investing in an office building or a local strip mall, the actual depreciation period is 39 years because those are non-residential properties. I want to emphasize one point. An investment in a single-family home as a rental can be depreciated over 27 and a half years. So, whether you bought a single-family home or a multi-unit residential property, those properties can be depreciated over 27 and a half years. All other types of real estate investments are depreciated over 39 years. One question you see sometimes on exams relates to the period for depreciating vacant land. The answer is that land cannot be depreciated. Land is indestructible. Okay, next, regarding depreciating other improvements, maybe you put in a walkway, road, sewers, fences on the property, or other improvements. Can they also be depreciated? And if so, what's the period over which they can be depreciated? Well, it's 15 years. So you can have various assets depreciated over different periods on your tax return. A couple more comments about calculating depreciation. First, when talking about buildings, real estate assets are calculated using a straight line basis, level depreciation deductions. If depreciating something other than real estate or improvements, such as fences, walkways, that kind of thing, you can use a different method for calculating the depreciation, the 150% declining balance method. By doing that, you can reduce the basis of the property quicker over a specific period. Most of you in class probably aren't old enough to remember when Reagan was in office. A recession occurred and a stimulus package was passed, significantly benefiting real estate. What they did was to allow the owners of real estate to depreciate the value of the improvements much faster, and they could use a 125% declining balance method. In essence, you could write it off quicker. The larger depreciation allowance reduces the investor's taxable income significantly. So we had situations where, as an investor, it was possible actually to increase the return on the property. In fact, when the investor used the accelerated cost recovery method, it could create a tax loss. And with that tax loss, at that time, not now, but at that time, the investor could offset the tax loss against their ordinary income. That was the greatest thing since sliced bread. Again, you won't be able to do that today, and I'll talk more about that later in the course. Here is a sample cash flow analysis like the one that we have been constructing for this course. It contains the same basic structure. These analyses work by starting with the cash flow up here on the top line, the potential gross, and then they deducted the vacancy. And they added any other income there, the $102,000. They came to the effective gross income of $2,272,000. And then they included all the property's operating expenses, which resulted in a net operating income of $1,265,700. Next, they calculated the taxable income. The taxable income calculation included deductions for interest and depreciation. Once the net operating income has been calculated, they subtract the interest expense and the depreciation, and we are left with the taxable income. Assuming a 40% tax bracket, probably 30% for the feds and 10% for the state. So, based upon that, 40% of this was $51,009. To calculate the before-tax cash flow, I take the net operating income and subtract the debt service. That gives a cash flow before debt service of $312,200. Finally, subtract $51,900 for taxes. That gives us an after-tax cash flow of $260,300. In our analysis, we will follow the same procedure. Let's proceed to the next lecture, where we will look through the tax analysis of our proposed investment in 757 Redondo.